Picking a HELOC or home equity line of credit lender should be very simple, but it's not. Everywhere you look, there are lenders, all with different terms, different fees, and different fine print. And if you're not careful, you'll pick the wrong one, and that mistake can cost you thousands. I know, because I've looked at almost all of them, and today I'm going to make this very easy for you. Here's what you'll learn in this video. Number one, the 4 factors you must compare before choosing any home equity line of credit. Number 2, how to avoid the traps that cost borrowers money every day. And number 3, the one type of lender that almost always gives you the best deal. By the end, you'll know exactly how to pick the right home equity line of credit lender in 2025. I'm Anitra Preston, co-founder of Vertical Capital, a private money lender in New Orleans and Baton Rouge. We also have a free community where we teach people like you to reach their first $100,000 in cash liquidity. If you want to learn how Will made $50,000 in cash in 12 months, or what about Eltis and how he made $18,000 in just 120 days, then join our free community. It's completely free. No credit card is needed to join. The link is in the description. If this is your first time watching and you find our content interesting, then like this video and subscribe to the channel. You've been missing out. Now let's break it down. Step 1, what is a HELOC? A HELOC or home equity line of credit is simply a revolving line of credit that's secured by your home. To learn more about what a HELOC is, check out my previous video, The Ultimate HELOC Guide. I break down everything you need to know about a HELOC, how it works, and what to use it for. Step number 2, the 4 factors that matter the most. Let's go through 4 factors that make or break your HELOC. Factor number 1, the interest rate margin. Every HELOC is based on the prime rate. Right now, that's around 7.5%. But here's the trick. Lenders add a margin or point. This is their profit. This can range from 0.5, 0.75, or 1 or 2%, maybe a little bit higher, just a little bit. But for the most part, this will vary from lender to lender, but not by much. Most lenders will be hovering around the same percentages. So if your lender says prime plus 1.5, your HELOC interest rate will be 9%. The lower the margin, the better. But by keeping your daily balance low and using your line strategically, you definitely have the control of lowering this even lower. To find out how we lower our effective interest rate every single month, join our free community and take our free course. And we also post daily on all things finance and real estate. Now, of course, these rates could be higher or lower based off your credit worthiness. Some will say don't be afraid to let 3 lenders pull your credit. Go shop around. But your credit score is what it is at the moment. I'm on the fence about shopping around when nothing about my credit or finances will change per application. Tell me in the comments if it's worth shopping around. From my experience, I'm confident that you will do better by building a relationship with the bank at least 2 or 1 year prior to you applying for a HELOC. And if you already have that relationship with a bank or a credit union, great. That's where you should start. There have been countless times that I have fared better this way than shopping around. True story. I have been with my credit union since I was 15 years old. They have financed every single vehicle that I've ever owned in my entire life. I've always paid my car loans on time, and I was never late. One time I was in a jam. My credit wasn't right, my income wasn't right, and I just had my second child. So I had 2 car seats and a Range Rover. This wasn't gonna work, y'all, and I needed a larger SUV. But there was no way I was gonna qualify without coming to the table with a large down payment. By the way, I have never ever in my entire life put a down payment on a car, and I never will. Anyway, I knew I could go straight to my credit union. My track record and my 25-year history spoke louder than my current financial situation. Basically, I didn't qualify for this car that I needed. But because of the long-term relationship and me never defaulting, they made me an offer that didn't require me to jump through hoops. It was simple and it met my needs. They were willing to finance it for me at a slightly higher rate for 12 months. Then at the end of 12 months, they would automatically drop the rate to a lower rate at that current time. In other words, I paid them a little extra in interest for just 1 year in exchange for me getting what I needed and for me not to have come out of pocket. Now this was a win for me. So be realistic about your current financial position. Understand your needs. Be aware of when a bank may be willing to work with you. I'm not talking about taking advantage of you. I'm talking about really working with you to help you get what you need. If you shop around, how much of a better offer would you get elsewhere? In other words, how much could your credit worthiness command? I'm not saying don't shop. I'm just saying weigh out all of your options first. If you are strong in the areas of credit and finance, then shopping doesn't hurt. And it could save you thousands of dollars over time. But again, like we teach in the course or in our free community, you have control over what's being charged on your HELOC. Factor number 2, loan to value or LTV. This is how much you can borrow compared to your home's value. Most lenders cap you at around 75 to 80% if this is your primary home, and some will go as high as 90 or 95%. Sounds good, right? But the higher LTV usually means higher margins, and that means higher payments. But as I stated earlier, you can control this higher payment. Let me add this. If they offer you a higher limit, take it. Don't leave no money on the table. On a HELOC or a personal line of credit, you are only charged on the amount you use. Just don't be irresponsible and reckless, running up the line on stupid stuff like restaurant crawling and vacations when you know you can't afford it. Getting a HELOC is not wise. I'm gonna say it again. Getting a HELOC is not wise if you are not fiscally responsible. Factor number 3, the appraisal. This one is huge. Not all appraisals are the same. Some lenders do a full appraisal or in-home appraisal where there's a full inspection where someone actually comes out to your house and they'll be inspecting the interior and exterior of your home. Others do a drive-by, which means they're just coming by to make sure the house is actually there, to be honest, and to just check out the area to make sure they're not getting into something, of course, that's undesirable. That can mean a big difference in value. Sometimes tens of thousands of dollars. I've seen appraisals differ by $30,000 or $40,000. That's money that decides how much you can borrow. Here, you just gotta ask these questions up front. What type of appraisal are you doing? Are you doing a full appraisal, or are you going to do a drive-by appraisal? Also, if you have or know a local real estate agent or broker or real estate broker, ask them to give you a BPO, which stands for Broker's Price Opinion, or ask the agent to do a comp for you. This can give you a benchmark or give you somewhat of an understanding or an idea of how much your home is worth. Appraisers and real estate agents or real estate professionals usually use the same data systems, aka usually called the multiple listing service or MLS, to gather their information. So if the agent or broker knows what they are doing, it should be within range or spot on with the appraiser. No shade to agents or brokers, but yeah, the appraiser gotta know what they are doing too. They don't always get it right either. Some people will say apply with at least 3 lenders and let them pay for their own appraisals. Not all lenders will eat this cost, and some will make you pay for it as a way to lock you in aka so that you're committed to them, and then reimburse you at the closing. Also, I say, don't waste people's time. As a lender myself, I don't like this, and you could potentially be blowing up a bridge before you even cross it. If you don't like your appraised value, so basically when the appraisal comes out or the appraisal comes back and you don't like it, you always have the option to challenge the appraisal. But the absolute best advice here is to just be prepared. Present your comps or your BPO to the appraiser and any recent upgrades or repairs. If this is a full appraisal where the person is coming into your home and not a drive-by, then build rapport. Meet with them at the door. Talk about the upgrades. Don't get in the way or be annoying or demanding. Just present your case for your numbers. This has always worked for me. There has never been a time it hasn't. Wait, no. Yes, there was at least one time where it didn't work for me. And this was because this appraiser, she just was not local. She was not even from the state of Louisiana. And she was scared of the neighborhood. I'm not gonna lie, it was a rough neighborhood, guys. But that's still no excuse for her to be way off with her numbers. This was a situation where we challenged the appraisal and even asked for a different appraisal. And after we challenged it and presented our numbers and got a different appraisal, it appraised for the value that we had expected. But you gotta do your homework and be realistic. As a realtor, sometimes you homeowners, yes, you homeowners, can be unrealistic and you want what you want. But I hate to break it to you, the market sets the value, not you, not your blood, not your sweat, and not your tears. And certainly not the fact that because you grew up here 30 years earlier. Factor number 4, fees and closing costs. This is where lenders hide things. Application fees. I shouldn't say hide things, but you need to just be aware of these things. Application fees, annual fees, monthly fees, prepayment penalties. So this happened to me just this past March. I had a $7,500 secured line of credit. It was in a CD, and I had just renewed the line of credit like 3 months earlier. I went to close the line and it was a ruckus. I wasn't aware that I was going to be charged prepayment penalties just to get my money back. I was smoking hot. So I went to acting all educated, I straightened up my back, and I was, when I was the one that was really the ignorant one, I went to asking questions like, well, was this in the disclosures when I closed the loan? I don't recall. Anyway, I don't recall anyone explaining this to me when I closed the loan. I went to fumbling through my phone, trying to look for my papers and my email, and of course I didn't find anything. Anyway, I ended up paying it because what I needed my money for far outweighed the cost or the fees for the prepayment penalty. But you gotta ask those questions up front. Some charge almost nothing up front, but they sneak in fees later. Others will waive fees if you open a checking account or set up a direct deposit. The key is to ask, what do I pay at closing? What do I pay each year? What do I pay each month? And don't forget to ask about promotions, introductory rates, waived fees, discounts for opening accounts. Every lender is different, so get every advantage you can. So step number 3, the best HELOC lender for 2025. So after all that, who's the best? Here's the answer. Your local credit union or your community bank, and then third, your regional bank. Not Bank of America, not Wells Fargo, but your local credit union and your community banks are the best. Why? Because real estate is local. They live in your community. They work in your community. They go to church in your community. They play in your community. They go to school in your community. They know your market. They know your property. And if you built a relationship with them, they actually know you and they know your history of how you pay on your debts and how you maintain your financial liquidity inside of their bank, so they know you. That means they can lend more aggressively and often at better terms. That's the difference. So let's recap. Always compare the margin, or AKA the rates. Be smart about LTV. Ask the questions about what type of appraisals are they conducting. Be prepared. Have a realistic idea about your home's value. Have your finances in order. And never overlook fees. Stay local, local credit unions and local community banks, then regional banks. Ideally, you should have a working relationship with one of these institutions already. If you found this helpful, hit that like button. It helps more people to find this video. Drop your questions in the comments or share your HELOC experiences, whether they're good and bad. And if you want to learn how to use a HELOC to build wealth and pay off debt, then join our free community. The link is in the description. But until next time, I'll see you guys later.